السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos. The rectangle formation is a classical chart pattern established by horizontal lines which represents the important support and resistance. Now this is a continuation pattern that forms a trading range during a pause in the current market trend. It is quite easy to identify the pattern because it has at least two comparable highs and two comparable lows. These highs and lows can be joined to make two parallel lines that form the top and the bottom of the rectangle. Now, a rectangle formation shows a period of indecision between sellers and buyers as they take turn throwing punches at each other, but neither of them have the dominance over one another. So the rectangle patterns are also known as trading ranges or congestion areas or consolidation zones. In this case, we are talking about continuation patterns, so we expect the price to break out and continue with the original trend. So in that sense, there are two types of rectangles. The top rectangle, which is formed during an upward price move, it signals the continuation of the uptrend. The next rectangle is formed during a downtrend and is called as a bottom rectangle, which signals that the down move will continue after the breakout. Now the rectangle patterns can also reverse the trend. So these reversal patterns are given specific names like double top and triple top when the price tests the resistance twice and thrice respectively and then moves lower. The other category is double bottom and triple bottom where the price tests the support level twice and thrice respectively and reverses upwards. So in order to clearly understand what the pattern is about to do, we have to wait till the breakout happens. So it is essentially a confusing piece of price action if you try to learn this pattern by heart. Now what I recommend is to wait for the price to give a real breakout and then decide if you want to trade with the trend or against it. So in short, in order to identify the rectangle pattern, we will need to locate a trending stock that is having a period of consolidation. And there should be minimum two tops and two bottoms that are horizontal to one another, which will act as the resistance and support levels. As I have mentioned, the top rectangle is seen during an uptrend. You would need to notice a breakout through the upper level of the pattern. Now this will confirm that the bullish move is coming back and traders can look to enter long positions when the pattern forms a break above the resistance level to continue with the bullish trend. While the bottom rectangle pattern is the total opposite of its bullish counterpart, this pattern occurs during a downtrend and the price would need to break the lower support level of the pattern to confirm its presence, and traders can look to enter short positions when the price breaks the bottom of the range to continue with the bearish trend. Now how to trade when you see a rectangle pattern? For a top rectangle pattern, you can enter a long trade when the price breaks above the resistance level if you are an aggressive trader looking for the best price to take an entry. The downside is that it could be a false breakout and you can get stopped out. The next approach is more conservative, where we will wait for the breakout candle to close above the resistance level. Most often, this method will reduce the chances of getting trapped in a fake out. But the only limitation is when the price breaks out with huge momentum and you will now be buying at higher prices. And finally, what if you miss out of the breakout completely? Then the only option available is to wait for a pullback or retest back to the resistance turn support level and take an entry from there. And if the retest doesn't happen, don't chase the price. Just avoid trading it altogether. You will find even better trades. Make sure that the volume rises during the breakout, indicating a higher buying interest. You can also use indicators like MACD, RSI, etc. to do the same. And for a bottom rectangle pattern with a bearish breakdown, our primary instinct should be to sell. Now here are the three entries possible. The most aggressive is entering as and when the breakout happens. The more conservative approach is to wait for the confirmation after the close of the breakdown candle below the support level. The final option is to wait for a retest in case you missed the breakdown. So I leave it up to you to decide. Make sure you validate the breakout with volumes and momentum based indicator each and every time. Now we will learn to set up proper stop loss. We don't want the stop loss to affect our risk management. So when you notice a rectangle breakout, you have to measure the distance between the support and resistance and then place your stop loss in the middle of this length. This is applicable to both top and bottom rectangles. Now your trade will be secured by doing this, and you will be aware that the maximum you can lose from this trade is equal to half the size of the pattern. Now after buying or selling on the rectangle breakout pattern, the stop loss should be placed at the midpoint because the breakout will likely to have shakeouts before continuing with the trend. Thus, if you put your stop loss at or just below the breakout point, the smart money will probably hit your stop loss before beginning to run with the trend. Now how to exit a profitable trade? When trading the rectangle pattern, there is a clearly stated rule about the minimum target. You should remain in your trade for a minimum price move which is equal to the size or the width of the pattern. This implies that the distance between the support and resistance of the triangle should be placed on the chart beginning from the breakout moment. Now, since the stop loss is at the midpoint of the rectangle range, it means that the target is twice the size of the stop loss. This enables a reward to risk of 2:1 from the offset. You can also use the trailing stop loss method if you want to ride the trend until it's exhausted. There is yet another way in which traders can successfully trade rectangles, and that is by buying at the support and selling at the resistance levels if the width of the rectangle pattern is very high. Now this can be used as an intraday or swing trading strategy if it provides a sufficient reward to risk ratio. So for a top rectangle pattern, you can take a long entry from the bottom support level and place your stop loss below the lowest wick or candle formed during the consolidation, and the target will obviously be the next resistance level. Similarly, for a bottom rectangle pattern, you can look to short when the price reverses down from the top resistance level and place your stop loss above the highest wick or candle that is formed during the consolidation. The target is obviously the lower support level.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.